All right, let's get right into it. So you've got this amazing vision, right? You're ready to open your own pharmacy. But then, boom, the big question hits, and it can be seriously overwhelming. How on earth are you going to fund this thing? Today, we're going to break down the two main paths, using your own savings versus taking out a loan.
You know, this quote from another owner just says it all, doesn't it? That feeling, the pure excitement mixed with this knot of anxiety in your stomach, it's that exact moment your dream slams into the reality of the balance sheet. And believe me, the choice you make right here, right now, can pretty much set the tone for your entire business journey.
So let's look at this the right way. This isn't just about where the money comes from, it's about choosing your flavor of risk. Are you the kind of person who's okay with a personal, all-in financial risk? Or does a more structured, formal business risk feel safer? There's no wrong answer, but it is deeply personal. And by the end of this, you'll have a much clearer idea of which one is right for you.
Okay, first up, let's talk about self-funding. This is what people mean when they say you've got skin in the game. And while it has some massive upsides, the stakes, well, they couldn't be more personal.
I mean, the appeal here is huge. You can't deny it. You're not answering to a bank. You don't have those monthly interest payments hanging over your head. Every single decision, from the color of the walls to the software you use, is 100% yours. It's the absolute fastest way to get your doors open with total control from day one.
Let's make this tangible. We'll use a real number. Let's say you need $50,000 just to get your initial inventory on the shelves. That's a pretty standard startup cost. Now, how you get that 50 grand is where these two paths couldn't be more different, especially when you think about what's really on the line.
And here it is. This slide just lays out the fundamental difference so clearly. When you use your savings, that $50,000, it might be coming straight from the equity in your house. The collateral is literally your family security. But with a loan, the bank usually considers the inventory you're buying to be the collateral. The risk stays inside the business. That is a massive, massive distinction. So as you can imagine, that creates two totally different kinds of stress. When your own nest egg is on the line, a slow sales week isn't just a business problem, right? It feels personal. It feels like a threat to your kid's college fund. With a loan, the pressure is still there for sure, but it's structured. It's a number on a spreadsheet, a payment you know is due every month. It's business pressure, not I bet the house pressure.
All right, so now let's flip this coin over and look at taking out a startup loan. This is the more traditional route, and it comes with a formal business structure, but that structure brings its own set of challenges. So the big win with a loan is getting a huge chunk of cash right at the start. You can cover your equipment, your rent, everything all at once. Plus, and this is a big one for the long term, when you successfully pay back that loan, you're building a credit history for your business. That's absolutely vital for getting more financing down the road when you want to expand. But, and this is a really big but, getting that money into your bank account is not an overnight thing. The actual journey to getting those funds, well, let's just say the timelines couldn't be more different. To get a loan, you are looking at a mountain of prep work. I'm talking super detailed business plans, 3 to 5 year financial projections, pages of applications, and then you wait. The bank's underwriting process can take weeks, even months. It's a true test of your patience. And the process for using your own savings? Well, here it is. One step. You transfer the funds. That's it. The difference is just staggering, isn't it? You're basically trading weeks and weeks of paperwork and nail-biting for instant, no questions asked access to your capital.
So, okay, we've seen the pros and cons. They're pretty clear. But here's the most important point of all. The best choice isn't found on a spreadsheet. It's not about which process is faster on paper. It all comes down to you. It's about your personal comfort level with these very different kinds of risk.
Seriously, this decision is way more psychological than it is financial. What's going to let you sleep at night? Is it knowing you have zero debt, even if your entire life savings are invested in the business? Or is it knowing your savings are safe and sound, even if you have a loan payment hanging over you every single month? So to help you figure that out, we can boil it all down to a pretty simple 3-point check. Just think about these 3 things: accessibility, repayment flexibility, and the classic trade-off between cost versus control. All right, let's dive into each of these. If you can answer these questions honestly for yourself, I promise you'll have the clarity you need to make a decision that you feel truly good about.
First up, accessibility. And be really honest here. Do you have the mental bandwidth and the time to go through that whole loan application grinder, or is speed the most important thing for you right now? If a perfect location just opened up, the weeks you'd wait for a loan could mean losing it.
In that case, the instant access of savings might be your only real choice.
Second, repayment flexibility. A bank loan has a schedule that is set in stone. If you miss a payment, there are penalties and your credit score takes a hit. It's unforgiving. But with your savings, you're essentially repaying yourself. If you have a slow month, you can ease up. So the real question is, are you confident your business can handle those fixed, rigid costs from the very beginning?
And last but not least, cost versus control. This is really the heart of the matter. A loan has a very clear financial cost. It's called interest. Your savings has a very clear personal cost. It's your security. So which of those costs are you more willing to pay? Paying a bank for the privilege of using their money, or risking your own money for the privilege of being 100% in charge?
So there it is. The choice isn't just about the money. It's about what you're willing to give up to get it. Your time, your control, or your personal security. You now have the framework to actually check in with yourself. So I'll leave you with this. When you look at your own personal balance sheet, not just the financial column, but the emotional one too, what does it tell you is the right path forward?